What's going on, guys? Welcome to Stock Talk with Nico Criticos. Today, we're going to do some stock analysis for Aurora Cannabis, ticker ACB. The first thing I want to start off with is just to get a general idea of how legalization of cannabis is going in the United States. It seems like every so often we have news that a new state or a new territory or another country is going to be legalizing it. And so this week we have one that a Native American tribe in North Carolina is going to legalize it on their territory. So that's something. And then we have other states like Minnesota. We have, I believe, Germany is starting to set a goal to make cannabis legal. So it seems like things seem to be moving in that direction more and more. And that's something to keep in mind if you're investing in a cannabis company. As for Aurora Cannabis, today the stock is up over 60%. It's up 80% on the week. And this stock is now trading at a $300 million market cap. So this company is headquartered in Alberta, Canada. And they are one of the many competitors in the growing cannabis space. So as for the reason why this stock is up, the news is that the company repurchased 12 million Canadian dollars, which translates to $9 million US, worth of its convertible senior notes in order to reach positive cash flow targets for next year. So it's not exactly what I was expecting. I was expecting something more like area of Canada is going to legalize cannabis or something, or maybe they got a certain deal with somebody. That's normally the types of things that make a stock go up 60%. But in this case, it's just that they're buying back some notes, which is good. They're going to pay off debt. It'll be less expenses, and then their cash flow will look better. So that is a good thing. Now, if we get into their revenue chart, we're going to see that they had some incredible growth from 2016 to 2020, and then since then, the last 3 years have kind of been decreasing. So not very consistent, not very good, and that's going to get a no. Net income, pretty similar story, not a desirable chart. It's consistently negative, and last year they did negative $1.7 billion. So the good thing I like about this stock, though, is that the valuation's not sky high. That's always makes me feel a little bit safer when you're buying into a company. So there is no price to earnings, but there's a price to sales, and it looks like it's about a 0.8, which if you look at the last couple of years, it traded as high as a 7 or an 8, and now with it being under 1, that is a lot more attractive. So it's like I feel like almost most of the companies in this space, you're taking on some risk because the future of the cannabis industry is a little bit, unknown, unpredictable. But if you're paying a sky high valuation of billions and billions of dollars, then you're really taking on a lot of risk, because then there's a really good chance that stock could come back down. But when you're only paying barely one times sales, one times revenue, $300 million, that's not that lowers the risk quite a bit. Is the company innovative? Yes, they're in one of the most innovative spaces you could imagine right now. The market share, no. Just like I made a couple videos this past week on other cannabis companies, and it's kind of the same story. For this stock, it's probably even more so the case that we're early on in the industry, and these companies are very small. They're only doing, a couple $100 million, maybe $1 billion or a couple $1 billion of revenue, and the market share is normally 1% or under 1%. So this is not a strong market share company yet, just because we're early on in the stages of the industry. Return on invested capital is negative, so that'll get a no. Now, for companies so early on like this, I can kind of cut them some slack on some of these things, like the return on capital, the profit margins, net income, some of these things where we know it takes years and years to have a company reach profitability and reach positive metrics on some of these criteria. But one thing that I still want to see, even in early stage companies like this, is growing equity. That's one thing that I still do want to see. So it's kind of unfortunate that they are not growing equity. Keep in mind, these numbers are in the Canadian currency, so you got to factor that in. If you translate it to American currency, it's about 75% of Canadian currency. That's the way I think of it. So equity in 2020 was $2.1 billion, and now we are down to only $500 million. So Now, again, that translates to, let's see, I believe I ran the numbers here, $368 million US, which is pretty much that's slightly more than their market cap. So again, from that perspective, it looks like a decent valuation. You're getting more in equity than what you're paying for the entire company. So that's a good deal. But as far as the trend goes, it's awful. The trend is going from $2 billion to 500 million Canadian. And that's over the course of 3 years. So that's really not what we want to see. Hopefully they can turn things around. The equity is it's over 100% of the market cap. Share count decrease. Here's another thing where it's like, I expect it to happen with these early stage companies, but it's nicer when you can only see maybe 5%, maybe 10% growth in the number of shares they're issuing. In this company's situation, we're talking about 60%, 40%. In the last 2 years, it's slowed down a little bit to 12%, but still, this number can, I wouldn't be surprised if this number shot right back up to 30 or 40%. So that's a lot of shares that they're issuing, which can have a substantial effect on pushing that stock price down further and further. So you have to keep that in mind. The assets this is one good thing. The equity is really the equity is not growing on the balance sheet. So that's really bad. The good thing is the ratio of assets to liabilities. We're looking at 800 million of assets, 300 million of liabilities. So that means their assets are more than double liabilities, which 90% of companies cannot say that. So that's one good thing about their balance sheet. Margins are negative. Cash and receivables are, of course, more than their negative income. No dividend. The company was founded over 10 years ago. And the free cash flow, okay, this one was interesting because this one I could have gave a no, but what I do like to see, what I'm happy about in this chart is that it's improving, and there's at least a couple years of them getting better. So it is negative. It's not good. This is not a good free cash flow chart, but it's at least improving. So that's what I like to see. So overall, this is not a stock I'd be buying. I would keep an eye out for making sure they improve their equity, but the ratio is strong on the balance sheet. And I would say you just got to watch out for, who gets the partnerships and how long does it take for the United States to legalize cannabis. Those are the things you got to look out for. But that is all for today. So thank you for watching, and I will see you in the next video.